Welcome to the What to Watch video update. This is the last video that I do each weekend, and I do a video every day. I do a weekly video. I do a thing called a deep dive video. I do an intermarket analysis video. And then at the very end, I go through and I look at all the charts that really seem to be saying something right now. And I come up with a positive list and I come up with a negative list. And then at the end, I come up with those things that could be positive or negative, but I'm just keeping an eye on right now to see if they have some kind of an impact on the market. This is being prepared for Monday, January 13th. Now, first of all, we look at the positive side. Even though we had a down week, interest rates are really going up, and that's pressuring stocks. The dollar's also going up, which is pressuring stocks as well. But there are still some things that we can look at inside the market because I look at lots of different charts, and we can come up with some positive things that the market may be able to key off of. Then after this, I'll go through the negative side. The first thing is the 100 period moving averages. And I say moving averages because I plot both a simple and an exponential moving average on all the charts because I'm constantly asked which one's better. So I say both. Most folks tend to use a simple moving average, but I also plot an exponential moving average. It moves faster, which some people think gives them an advantage, but tests have also shown that simple moving averages are better because faster is not always better. Sometimes if you would wait, things have a tendency to work out. And there are millions of people that use moving averages, and I'm not trying to necessarily look at something that other people don't already see. I'm just looking at the same things that lots of other people are looking at and using to make decisions. And a large part of technical analysis can be a self-fulfilling prophecy where they see us coming either up to a moving average or down to a moving average. Oh, I think I'll jump in and buy. And then that ends up being a valid signal. Well, what happened on Friday is for the first time in a long time. In fact, I don't think we even hit this, yeah, in the length of this chart. Well, other than the big downward move that we saw last August, where the end of the world was happening, that lasted a couple of days. We have not come down to the 100 period moving average. We got close a couple of times. We fell below it, like I said last summer, but we are still above the 100 period moving average. Now, a lot of folks don't really use this one as much. I didn't use it for a long time. And then you get into these more lethargic type market environments where we're trending, but it's not a real strong trend. And I find that the 100 period moving average can be quite useful. So I watch it all the time. I don't show it in a lot of videos because it doesn't really come into play. Well, after Friday, it came into play. We came down to the 100 period moving average, broke a little bit below that, and then we were able to close up off of that. Is this going to offer some kind of support to bounce up off of? Now, if that happens, that could turn things more positive. And we're still positive with this chart because we're above the 100 period moving average on a closing basis. If we break below this, the next major moving average that I use is the 200-day moving average, and that's the long-term trend, where I look at the 20 period moving average for the short-term trend, the 50 for the intermediate term trend, and then I break out the intermediate to a little bit long term. That's the 100 moving average. That's what you see right now. And then I use the 200 period for the long-term average. So for right now, this is hanging in there positive. We'll see if we can bounce up from that. Here are all the different moving averages. We're below the 20, we're below the 50, we're just a little bit above the 100. Okay. Now, chart is clearly negative. We have the histogram red and looking not all that positive right now. But if you remember back to Friday, we had a pretty significant down day in Friday's session. Do you notice what's been happening here? The histogram has actually been going up and the red line is starting to turn back up. This is a smart money indicator. It uses not only price but volume to do its calculation. It's the Chaikin money flow. And this can sometimes signal to us that maybe under the surface, we're not seeing it based on price, but there's some smart money coming in and actually doing some buying. Now, we've seen this before, only to have it fall apart. So we don't want to put all of our decision making into this particular chart, but it is one chart that is giving us a little bit of hope right now. Then we're still looking good. And I've been saying this since the last part of November. When we compare growth to value on an intraday basis, growth on an intraday basis as well as a closing basis on all of the different indexes that I follow, it's still holding up. And that's what you want to see when the market is still positive. We're just not seeing it coming through to price right now. But we'll keep an eye on this. Now, the green, not green, blue, the blue line, it's taking a hit here. There's no doubt about that. But even though these are on different scales, the blue line is above the red line. Value's really been getting hit hard lately. That's the red line here. But as long as the blue line's still above the red line, we treat this in a more positive manner. If the red line comes up or the blue line goes down and they cross, that's when we're going to see this as more negative. Now, this isn't a hard and fast rule. There are times when value does well and growth does well and we still go up. So this is just one thing that we use to look at. We also look at S&P growth of value on an intraday basis. We've been going down with the S&P, but you see how so far in 2025, this ratio is holding up fairly well. It's not going up big time, but it's not going down big time either. And this could be under the surface positive. An end of day chart showing growth of value. It actually went up in Friday's session. So this is still in an uptrend overall, and this is under the surface, potentially positive. But I've been pointing this out for quite some time. When we really started to go up here, this was actually last fall. This has been doing quite well, and it is in an uptrend. And there have been times the S&P set its all-time high back on December 6th. We'll have to see, is this going to follow through into any kind of positive price action? We look at a growth ETF and compare it with a value ETF. Even though we're coming down with this ratio, it's still looking really strong. And then we look at discretionary to staples. Discretionary has been the strongest area of the market going back to that big crash in August, and it's really been going up all by itself. Now, it's getting hit lately with everything else, but when we compare growth in the top area with staples in the next area down, staples have been under a lot of pressure, and that's helping the discretionary to staples ratio go up. This is under the surface, but we've been seeing this now for quite some time, and it hasn't really come through into price. But just know it's under the surface and in the background. Okay, we look at growth to value ratios. The Qs to S&P coming down to its moving average. The moving average is starting to flatten out. With discretionary to the S&P, we actually fell below the moving average, and the moving average is starting to go down, but we came up in Friday's session. Not really strong right now, but not overly weak either. And when we compare large cap growth to large cap value, we're coming back down to the moving average. So this is holding up, not showing a lot of strength right now, but it's not falling apart. We look at the large caps back down to the moving average. We actually bounced up with the mid caps and the small caps at Friday's session, and we're above the moving average. Small caps have been very frustrating to folks. In fact, they're breaking to the downside right now. So we're not seeing that with price, but this is not what you see usually when the market's getting ready to fall apart. Okay, then we look at small cap growth of value by itself. It went up. It's in an uptrend, even though the index, it was going sideways. It's been range bound for quite some time, but we were in a range here, but now we're potentially breaking to the downside. That could be negative. That doesn't mean we're necessarily going to bounce up from this. That could mean that we're going to see more further downside with the small caps. We're seeing kind of a similar thing, although we haven't broken out to the downside with the mid caps. We're at the low end of this recent range that we've been in, but the growth to value ratio is still holding up quite well. Now, this is interesting because here on the weekly chart, this is a point and figure chart. It doesn't take time into account, it just takes price into account. We actually had some green X's. That's positive because earlier in the week we went up. Then we spent the rest of the week. Well, Wednesday was a non-event. Thursday, the market was closed, and then most of the losses were saw. Tuesday was kind of weak, and then Friday ended up being weak. But this was enough of an upward move here to generate a couple of X's. Now, we don't have a signal that's been triggered here, and we could be hitting some kind of a double top right now if we see more weakness from this longer term. But to see green X's is positive in and of itself. Now, unfortunately, when we get to the negative side, I have a daily point and figure chart where we're seeing O's being drawn in here. Okay, the FANG index. These are the really big companies: Facebook, Apple, Amazon, Netflix, Google, Nvidia. They're coming down and actually breaking down below this recent range that we've been in, but they're still above their 50-day moving average for the time being. And we've been following along with a short-term trend line. We have not been able to get back above that. We're coming back down to this longer-term trend line. If we see more weakness with the FANG index, is this support level going to hold? Another area, high leverage loans. These are very risky. This is what people are really leveraging themselves to get into these kind of loans. Well, there's an ETF that's backed by this. And if the people in this ETF were really concerned about the economy, this ETF would not be doing as good as it's doing. It's well above its 50-day moving average and has been in a really solid uptrend here. So this is another barometer that I use to look at the economy, and this is not really showing any weakness right now. A long-term chart of the S&P 500, a weekly chart, even though we're coming down, we're still above this long-term trend line going back to 1987. The NASDAQ 100, also still above this long-term trend line going back to 2009. We look at growth, the NASDAQ 100, and do a ratio with value or the Dow, even though NVIDIA's in the Dow now. But if things were getting ready to fall apart, we would see like what we saw back in the year 2000. We came up, set a high level with this ratio, and then just tanked after that. We've shown some weakness along the way, but we're actually going up with this ratio right now. Not what you see when the market's getting ready to fall apart. Also, we look at the QQQs, the NASDAQ 100 to the small caps. Back in 2000, it gave us a very high reading and then tanked after that. We're up back to this blue line and we're actually going above it now. Again, not what you see when the market's getting ready to fall apart. Then we look at the tech sector. Now, there's some weakness coming in here, and we compare it to 3 to 7 year bonds. But we're still at the high end of this rainbow. It hasn't been falling down as much as some other ratios that I've been watching. And the tech sector is a really strong area. We need tech to do well for the market to do well. And this, for right now, has been holding up. Okay, so there's kind of a short list on the positive side. Now let's go and look at the negative side of things. All right, this is the intraday chart. Quite often I don't show it in this video, but I wanted to because you see kind of a pattern that played out this whole week. We gapped higher in Monday's session and everything was looking great. We were just going up. We weren't setting any kind of all-time high, but we were looking pretty solid. And then everything just kind of slowed down and fizzled out. And then we had a really solid decline going into the close. Now, on a closing basis, we were up. But if you just take the open, the high, the low, and the close right here and don't count in the gap, this is not a very positive day. And you see, we just pretty much continued that into Tuesday's session. We tried to gap higher, but quickly came back down, and we just kept going and going, closed near the low of the day. Now, Wednesday, it was the day before the state funeral for President Carter. The market, we were well below average with volume. We tried to go up a little bit, tried to go down. This is about the 50-day moving averages, the exponential version, and that's as high as we could get on Wednesday. And we went a little bit up, a little bit down, and pretty much went nowhere by the time we were done. There was no session on Thursday, and then the employment report came out on Friday, a lot stronger than expected. So the economy's not falling apart. It's looking pretty strong. And that freaked out the bond market. So bond prices ended up going down, which means interest rates were going up. That freaked out the stock futures, and we ended up having a gap lower. We went down pretty fast. We came down here to the 100 period moving average, and it looked like we were staging a nice little bounce after that. But maybe it happened too early in the day because we were starting to go back up, and then some massive selling came in, took us back down, and we closed not too far off of the low, but still up above the 100-day moving average. Now, I wanted to show just a blank chart because sometimes you can get a lot of clues by just looking at a price chart, no indicators or anything else in addition to that. One thing I will tell you, if you're not familiar with my videos, I'm not a rising wedge person. I don't draw a lot of lines. on charts. I think horizontal lines are more powerful than up or down lines, trend lines. But I do like to look at price action. And we're seeing something here that could be negative. We came back and hit the all-time high back on December 6th. Okay, everybody's happy. They're in the Christmas spirit. Everything looks great. Well, then we just kind of chopped sideways. And then we had that big down day when the Fed made their announcement. Okay, and then the market kind of had to recoup a little bit there and just get its breath back. And we came back up and we set a lower high here. All right, not a big deal at this point. Then we started to go back down and we actually set a little bit of a lower low here. So now we're starting to see a pattern. We have a high, we have a low, we have a lower high, and just barely a lower low. We tried to bounce back up here. We set an even lower high right now. And then in Friday's session, we set an even lower low. So you can kind of draw a line right here where we're seeing a series of lower highs and we're seeing a series of lower lows. Now, the market could recoup from this. And there's lots of people that are seeing this and thinking, oh, the market's going to fall apart. And it could. And this is negative. If we can bounce back up out of this and negate what we're seeing here and get back above these previous lower highs, that would turn everything back more positive. If that doesn't happen and we continue to drop from here, this is going to end up being, oh, wow, didn't you see that when it was happening? That's why I'm trying to point this out right now. Okay, large cap growth. This has been a positive area when I'm doing these videos and the daily videos. Well, we dropped below the 50-day moving average. This was a stronger part of the market. And even though we were going sideways and under pressure and interest rates were going up, this ETF was holding up. Well, we came down below the 50-day moving average. That's the negative side. The positive side is the blue line still going up, the green line, which is a 100 period moving average, and the 200-day moving average in red. These continue to go up for right now. Then on a short-term basis, I use a thing called the ADX, average directional movement, because it gives you a lot of information. The first thing that we look at is the dark black line. That's the ADX itself. That's the actual indicator. When that's going up, that means the trend is getting stronger. Now, I also put a moving average on here just to give it a little bit more context. I put that on there myself. When we're above the moving average, that means the trend is stronger. Now that's more dynamic. The moving average changes every day. I also use a static number of 20. That's where you see this blue line right here. And so there's a static part and a dynamic part to this indicator. So one thing stays fixed and the other one can move based on what's happening. So this suggests that we are above 20. So we are trending and the trend is getting stronger because we're above the moving average. Now, how is it positive or negative? The red line is above the green line. Red is negative, green is positive. We're seeing the red line going up and the green line going down. So this is a strengthening trend that is negative in the short term. And we're seeing that same thing now in the intermediate term. This is the chart I really focus on the most. We're going back above the moving average. We're above 20. That's a strengthening trend that's negative because the red line's going up and the green line's going down. Okay, so intermediate term and short term, we are negative, not only based on moving averages, but here based on the average directional movement indicator. The condition of the short-term trend, we're underneath the green line and the blue line, and these lines are going down. That just means the short-term trend is showing more weakness. We look at a simple and exponential moving average of the short-term trend based on 20 periods. We're down below the lines and the lines are starting to go down. This is why the short-term trend is negative. Then I have a long version of this same chart, same basic idea, which is called a short-term rainbow. Excuse me. We go from 10 periods up to 50 periods with moving averages. We're dropping below the rainbow now. Where when we were really going up, we were above the rainbow and the rainbow was going up itself. Now we're coming down into the rainbow. We've been chopping around. All the lines are getting all tangled up with each other, and we're falling below this. This also suggests the short-term trend is, it just confirms that it's negative. But I have another thing called the boom indicator. This measures how far away do we get from specific moving averages. And we're getting kind of far away from the 20 period moving average, the short-term trend. We use this like an oscillator when it gets extreme positive or negative. We're getting extreme negative with the short-term trend. Now we're dropping below zero and declining with the distance away from the 50 period moving average, which is intermediate term, and we're coming down but still above zero with the 200 period moving average. The reason I'm pointing this out is sometimes when we get down to a low reading, we could still go lower than this, but often when we get below this red line, that can produce some kind of a bounce. This is a condition of the intermediate term trend. We're below the red line, below the blue line, and we're going down with the lines and prices below the line. So this is suggesting that the intermediate term trend is negative. We're also negative because we're below the simple and exponential moving averages. We tried to get back up it on Wednesday. That was the high that we set, and then we just came crashing down. I shouldn't say crashing down. We declined because anytime we have, ooh, we were down 0.25% today, the perma bears call that a crash. Okay. So anyway, but we're looking more negative here in the intermediate term. And then I have another rainbow that corresponds with that. Now, these lines have not really started to roll over yet. This is a slower moving rainbow, but we're down to the bottom end of it. We're right at the 100 period moving average because this rainbow goes from 50 periods up to 100. Now, if we can bounce back up out of that, the lines should still stay intact. If we continue to fall below this, the lines are going to roll over and turn more negative. Then there's another indicator based on the S&P 500 where I take the advancing issues and subtract the declining issues and then take a 10-day simple moving average of that. And then you can use it like an oscillator. So I call it the advanced decline oscillator. We were looking a lot better. We had an extreme negative reading back in December and we were starting to bounce back up. We actually crossed back above zero. That's when this indicator turns positive. Well, then everything kind of changed and we came back down below zero and we're continuing to decline. Now, if we get down to this green line, that's going to make this extreme negative. If at some point we bottom out and we bottom out at a higher point than this previous point back in December, that could be a positive divergence. But we don't know that yet. We're just going to be watching for that right now. We don't know if it's actually going to play out that way. Then this is the negative point and figure chart. On the weekly side, we saw a couple of green X's. Here after Friday's session, we saw a couple of or three red O's here. Shorter term, we're looking more vulnerable. Longer term, we're still hanging in there a little bit better. Sentiment, we're getting way down here. People are not happy right now, and we're getting close to this 25 level. If we drop below 25, then we could go below it. We've gone below 25 before. We could get down to 23, 22, 20. It could theoretically go all the way down to zero, but it doesn't ever do that. But once we drop below 25, if that happens, this is when we look at using this as a contrarian indicator, meaning the folks are too pessimistic. They're selling just to get out of the market. They've lost all their confidence right now in the stock market, and they just want to get away from it all. That's when we want to look at come in and start doing some buying. But we're not quite there yet. Now, we usually use the context of this line. If it's going down, that's negative. If it's going up, that's more positive. Well, right now it's going down. So it's negative and getting close to an extreme negative reading. The VIX is going up. Now, the positive side, we're still below 20 on a closing basis. But the fact that we're going up, that makes this negative, and we're above these moving averages here. We got up to 20 on an intraday basis, but we didn't close above 20. But if we do go above 20, that's going to turn things a lot more negative. And the momentum, which had been flatlining as measured by the MACD, it's now starting to go back up as the VIX has been going up, and that's negative for stocks. Now, Tom Bowley did this research, and it's over a year old now, but the premise doesn't change, the actual conclusion that you want to reach with this chart. When we're below 20, that's when we see positive annualized returns. Now, the further we get below 20, the better those annualized returns get. When we start to turn negative on an annual basis is when we get above 20. That's why it's pretty important to keep an eye on this, and we're close to 20 now. We closed at 19.54. If we get up into this red area and stay up there, that could be more negative for the market. And now, longer term, we're still positive with the advanced decline line studies here, but we're really coming down now, both based on price and volume. And we were seeing some improvement with the new highs, new lows. This is another internal measure that we look at. Well, Friday didn't help things out. We saw a real expansion of the new lows. We saw a few new highs here. We were trying to turn up with our 5-day and our 10-day moving average, but with Friday's downward move, this is now looking more negative. But if we get to a really extreme negative reading, this can sometimes act like a bit of an overbought, oversold indicator. Then we're below zero and declining with the advanced decline ratio. And this is short and intermediate term. Short term is 19 periods, intermediate term is 39 periods. And this was not really sure. I wouldn't pay attention to the bottom area here. This is a thing called the boom indicator. And this is trying to say that we're way far away from the moving average. Well, you can just look at it and see, no, we're not, but we are below it. And that's making this chart more negative. This is a smart money indicator. You remember the chicken money flow? That's another smart money indicator. That's giving us some hope right now. This one is more negative because it takes price and volume into account, and we're going down below the moving average. Also, the Chaikin oscillator, which derives itself from the Chaikin money flow, it's declining and below zero. So, two out of the three smart money indicators that we look at are negative. Now, even the third one is still negative, but it's showing some improvement, possibly. And the vortex, this is very easy to interpret. The red line's above the green line, so we're negative. The red line's going up, but the green line's going up. That's kind of interesting. We had a pretty significant down day on Friday, and to see the green line going up, that's why I treat this as a primary indicator. Sometimes it can give us some clues that we're not seeing just by following price. This is another interesting thing in here, and this is like apples to oranges as far as comparing things. The bar chart is the S&P 500, and it has its own advanced decline line that we were going through. Well, just for kicks, here's a study that takes the S&P 500 and compares it to the NYSE advanced decline line. Now, the moving average that you see on here, this is the moving average of the advanced decline line, not on the S&P. And we're coming down to the 200-day moving average here. Could something happen? Could we bounce up off of this? Maybe. Now it's negative because we're going down and the S&P is going down, but maybe something positive could develop here. Parabolic SAR, first I look at a daily chart. We're negative since the dots are on top. Then because it's the weekend, I can show you the weekly chart with the finished week. That's also negative, and that's kind of negative longer term when you have the daily chart and the weekly chart both negative at the same time. And we look at the cumulative advanced decline line for the NYSE dropping down in Friday's session below the moving average. Then we look at a regular advanced decline line for the NYSE. That's been chopping around, but below the moving average, where when we were a lot stronger, we were above the moving average and the moving average was going up. Now the moving average is rolling over and the value here is actually below the moving average. That's more negative. The S&P McClellan oscillator. We were looking better, but we're still below zero. We dropped down in Friday's session. Now, when the McClellan oscillator is below zero, the summation index, which gets its value from the McClellan oscillator, this is declining based on price, and we were looking better. We were actually seeing more of a mixed signal where we were coming down based on price and going up based on volume. Not now. We're going down based on price and volume. And so taken together, this is more negative. Then we look at the NYSE McClellan oscillator. We actually tried to get back above zero. That didn't last too long. We dropped down back below zero here. So we're back to declining with the summation index based on price, and we're back to declining based on volume. We were seeing little signs of hope here, especially with volume. It was trying to turn back up even when price was still going down, but we kind of lost that in Friday's session. Momentum, we're negative across the board. I have two short-term oscillators here. They're both going down. Then I have three intermediate-term oscillators that are declining, and I have two long-term oscillators. They're also declining. This was giving us some hope as well. We actually crossed slightly above zero with the Swenlin trading oscillator based on volume after Wednesday. It came back down below it after Friday. So now this is looking more negative. We're turning down based on price and volume. The bullish percent index actually had turned positive because we started to go back up and we were above the moving average. So I was declaring this positive. No, we're falling back down below the moving average and declining now. So this has turned negative again. We're also declining with the NYSE bullish percent index, and we actually crossed above 50 with the NASDAQ 100 bullish percent index. Not after Friday. We dropped back down below 50. So all three of these are now negative after last Friday's session. And the stocks inside the S&P above their 20-period moving averages, we were trying to bounce up here, but now we're coming back down. Now, one thing that we're going to be watching for, you notice when we came down earlier in December and had a really low reading, we came up here, we got almost to the green line and then came back down and then started to go up again. That could be a positive divergence because we set a higher low here and we actually set a higher high. You could say with this indicator too. Now we're going to have to see how this plays out. If we come down here and bottom and start to go up and it's a higher low than what we've seen previously, that could be positive for the S&P. But right now, no, it's negative. We are declining and not really showing any signs of slowing down at this point. There's also a study that we follow that goes along with this, also showing that potential positive divergence here. But when this really gets positive is if we thrust up to 70. We're not even close. We're going down. We're below 20 right now with this. Stocks above their 50-period moving average look like, okay, maybe we were hitting some kind of a bottom here, starting to bounce back up. Now, we didn't set a higher high here. We set a lower high, and we're breaking below 50 here. This is actually turning more negative than what it was back in December. This is showing the intermediate term trend is more vulnerable. Stocks above their 100-day moving average, also dropping below 50 and really going down big time. This is one thing that's slightly positive for the long term. These are the stocks above their 200-day moving averages inside the S&P. We're barely above 50. We're at 50.8. Now, if we drop below 50, that's going to turn this negative. But for right now, I could have put this on the positive side, but I like to leave all these charts together because they kind of try to tell a story here. But this is negative, but still hanging on to being slightly positive. And this is a variation of that. And for a long time, I haven't shown this chart. I've only been showing it in a deep dive video where I use that same stocks inside the S&P above their 200-day moving average. I use it like an oscillator to get an extreme positive or negative reading. Well, I just wanted to show it in a little bit different context. We're not getting any kind of an extreme reading, but we're getting really close to this green line, which is the 50 level. So these charts are the same. They just look a little bit different. And we're dropping below the cloud here with the Ichimoku cloud. And the blue line's below the red line, and the green line's coming down here when we do the full study. This had been a support level that it had been holding. This whole cloud is considered support. So right now, yeah, it's looking a little bit more negative. Now we could get that back, but if we continue to fall further, that's going to be even more negative. Here's a long-term rainbow going from 50 periods up to 250 periods. Now, this could be considered positive because we're not really rolling over with the lines, but we are looking a little vulnerable right now. We're coming down into the rainbow where we spent most of 2024 above the rainbow, and then there were some pullbacks along the way, and that's what we're trying to figure out. When we come down into the rainbow, is that a pullback before we get set to go higher? You can make a case for that. Or is this just the beginning of what we saw at the beginning of 2022, where everything was looking great at the end of 2021 and it just kept getting worse and worse and worse and then developed into a cyclical bear market for most of the year until we bottomed in October of 2022. That's what we're trying to evaluate. That's what we're trying to evaluate right now. And I don't forecast. What do you think's going to happen? What I think is going to happen is what I see right now, and then I reevaluate these things on a daily basis. Now, this is actually positive. The trend channel going back to 2009 for the S&P, we're well above the midpoint, and we're looking pretty good here. But we hit the upper end of this trend channel, and we've been coming down pretty much ever since. That's the negative side of this. Now, we went above the trend channel in late 2021. The market was just automatically going to keep going up. Throw money at the market. Well, then 2022 started, and that's when we saw everything switch over and look more negative. We're still trying to figure out, is this just a pullback before we get set to go higher, or is this the beginning of something that's going to be more negative? The advanced decline line is not looking good right now. On all the different indexes that we follow, we're below the moving averages and declining, and the moving averages are starting to go down. The Dow's below its 50-day moving average and broke down out of this recent range that we've been in. The Nasdaq, this had been a more positive part of the market because it was holding out above its 50-day moving average. We would drop down below it intraday, but we would always come back and close back above that level. We lost that both below it intraday and then we closed below it in Friday's session. Seeing that same thing with the Nasdaq 100. So this had been a more positive area that's now turning more negative for the time being. The momentum for the NASDAQ 100 is negative. This is a PPO, which is a momentum oscillator, and it's going down. The Qs, I have a 20 period moving average here. We lost that. That turned the short-term trend for the Qs, which is the NASDAQ 100, negative. And we were holding out above the 50-day moving average. We lost that in Friday's session. Small caps. Now, there's a negative side here is that they're going the opposite way of what everybody thought they would. They should have been just screaming up and really going higher. They're down below their 50-day moving average. But now there's two small cap indexes that I look at. There's the S&P 600. That's what you see right here. We're down to the 200-day moving average and we bounced up slightly off of that. Could this be some support? Other times that seemed to help out. So maybe we'll get some support from the small caps. Now, if we continue to break below this and close below it, that's going to turn things more negative for the small caps. Now, just to give you an idea of what's going on here, there's another small cap index, the Russell 2000. We're not down to the 200-day moving average here. That's why I watch two of them, because most folks focus on the Russell 2000 and they don't even watch the S&P 600. Well, I watch them both. And we're getting some clues from the other chart that we're not necessarily seeing here, other than we're negative. We're below, we're actually starting to get extreme negative with the RSI. Momentum is clearly negative with the MACD going down. Mid caps, they haven't quite broken below the range yet here, but they're just not showing any strength. And a lot of this is blamed on interest rates. The Wilshire 5000, a broad market measure, we were hanging out, holding on to the 50-day moving average. We lost that on Friday. Well, actually, we lost it on Wednesday and then kept it lost even more on Friday. This is a total US stock ETF. We were hanging out around the 50-day moving average. That came down below it more on Friday. Financial sector had been a stronger area, was really helping the market to go up. Now, it's still positive. We still have an uptrend going on here, but we've fallen further below the 50-day moving average. Total bond ETF. When this is going down, that means interest rates are going up. A week ago, I pointed this chart out that we were at the 200-day moving average, and maybe, just maybe, that would provide support. Nope, we broke down below it. So this is turning more negative. This was on what I'm watching a week ago. Now it's on the, uh-oh, this is negative list. And this is because the 10-year yield, especially, we're really going up right now. And that's freaking out stocks. And we're also seeing the 30-year bond yield getting close to that 5% level. If we go up when we hit that, we're at 4.97% with the 30-year bond yield. If we hit that, is that going to stop? It's a round number. Are we going to be able to hit that and then come back down from there? That would have bond prices going up and interest rates going down, which could support stocks. And this is kind of what I'm looking at here. I have a bunch of different maturities. The black line is the 30-year, and it's kind of going against what you would think should be happening. When the market really started to take it seriously last late spring and into summer that the Fed was going to come in and cut rates, interest rates really started going down. Well, then they cut rates in September. So the Fed has rates going lower. Now, those are short-term rates, but then interest rates here started going up. And that the market didn't seem to mind that. It was still going up, setting new all-time highs, doing really well. Then we went through another period of time in early December where interest rates were coming down, and that's when we set the all-time high with the S&P. But then we started to see stronger than expected economic reports coming out, and that started bumping interest rates back up. And we got above that 4.5% level with the 10-year yield, and that's when it really started to affect the stock market. And for right now, they're continuing to go up. And we'll be watching this 5% level here with the 30-year yield to see if that ends up turning into something. Then we're looking at a ratio between home construction and 3 to 7 year bonds. I've been showing this in the daily video too. the 250-day moving average, it held in 2023. It held earlier in 2024, broke below that this time. So that's turning this area more negative. We look at the semiconductors, that's a growth area, to Dow, which is more value. Now we're a little further away from the blue line. Now we're not, just tanking and going down big time, but I've been really focusing on the semiconductors lately. And the fact that this is showing some weakness right now, where it had been showing strength, is more negative. And some areas that I'm watching, and that includes a lot of the semiconductors right now because we're getting some mixed picture signals here. Excuse me. Sorry, I do all these videos take one and I don't edit them. And I sit for long periods of time and then have to record, and my voice doesn't get used very much. This is the SMH semiconductor ETF. I even though we're coming back down here, we're coming down to the 50-day moving average, and the blue line's still above the red line. We're still in an uptrend here, but we've been chopping sideways. Going into to July in 2024, this was just screaming up and really doing well. Then after the summer months, it just kind of came down and just went blah, 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 sideways. We need this to kick back into gear to really help lead the market higher. This is a rainbow where, if you notice, on a closing basis, we came up to this level, came up to this level again, came up to this level again. Is this some kind of a problem that's developing here? Now, this is still holding up, but you can see the lines in the rainbow are getting all jumbled up. We're going to need to turn and go back up, take out these previous highs, and then continue to go up from there to be more positive. But I'm just watching this for right now because it's such a huge part of the market. But then when you look at the SOX index, which is the semiconductor index, we're negative on a trending basis. We were able to get back above the 200-day moving average, but then we came back down to the 50, and now we're even below the 50. So this is why I say we're getting mixed signals right now. Then we look at a ratio between the semiconductor and tech, and that had been starting to go up, and that was looking better for the market. Well, now it's starting to come back down. We need to see some sustained move to the upside to turn this back more positive. Then here's another index that we look at that was really, it looked like it was breaking out. This is the Dow Jones Semiconductor Index. We had a high here, a high here, a high here. We actually went out. Oops, are we breaking out? Nope, fake out. We came right back down and we're at the 50-day moving average. Now, longer term, this is still positive though on a trending basis. We want to keep an eye on weekly jobless claims because if we're getting ready to go into a recession, the employment situation should be falling apart. It's not falling apart when jobless claims are going down and the moving average is going down. People are not getting laid off. But we're seeing a little bit of a pickup here in the continuing claims. So if people that do get laid off, they're having a little bit more trouble finding a job. But even though we came up in the latest reading, the moving average is still going down. This also suggests, for the most part, even though this chart has been going up, the moving average recently has been going down. And so this just shows that the employment situation is strong. And I plot all three here. I don't have any moving averages or anything here where it shows in the latest reading continuing claims went up, where initial claims went down, and then we had the unemployment rate that ticked down to 4.1% that came out in Friday's session. This is to supply some kind of context to the things that are going on. The skew index, and I've tried to interpret this, whether it looks like we're going to move up or we're going to move down. But when we get up into this red area, the market is expecting a big move of some kind. We've had up moves and this chart has gone up. We've had down moves and this chart has gone up. And then the opposite has happened. We have been coming down, but then we shot up, or we shot down in Friday's session, and this is going back up now. Are people expecting a big up move? I'm not sure. About the time I think I have it figured out what's going on here, the opposite is what ends up happening. So I'm just saying a big move is expected, and we're going to keep watching this, and we have been watching this for quite a while now, and it hasn't dropped out of this red area yet. Mass index. Okay, don't see this chart very often. This could be getting ready to tell us something. So we're watching it for right now. When we go above the red dashed line, that's trigger number one. Then if we go up above the blue line, which we haven't done yet, that's trigger number two. When we come back down and cross the red dashed line again, so there's a three-part trigger here. Whatever the market's doing at that time, the mass index tries to signal that there will be a reversal. Now, it doesn't always work, but there's been some fairly good signals along the way if you want to pause this and look at other times when this happened. So we're just watching this because there's only one out of the three signals that have been triggered as of right now. Another one, the Pring bottom fisher. Now, this is actually giving us some pretty good signals. The idea behind this is when we're just screaming down and really seeing some weakness, like 2022 style weakness, then this thing bottoms out, it starts to turn up, and it gives us a nice little bounce signal. Well, we got a pretty good signal here back in November where we shot up after the election and then came back down and went sideways. This crossed over positive and produced a nice little move after that. This is starting to cross over now. So we'll just keep an eye on this. Now, this isn't much of a decline in the bigger picture of things, even though we've been going down. But to see this triggered, we just want to pay attention to this and see if it's going to turn into something. And we keep an eye on the ratio between stocks and bonds here. And when we're up and going up like we have been, that means the market is anticipating a soft landing. That means no recession. Now we're taking a bit of a hit here, but we're still seeing all the lines pretty much going up. When this is going to turn really negative is if we drop down below the rainbow and then the rainbow rolls over. Even though we're going back into the rainbow right now, we've done that before and then we've been able to recuperate. So we're just watching this to see because 2022 started out really good and then it just morphed into something really bad. And so I just want to watch this. Things are still looking okay for right now, but we just have to watch it unfold. Then we look at the QQQs, the 3 to 7 year bonds. This had been a stronger area of the market. Now it's starting to come back into the rainbow. We're watching this to see if we bounce back up or if we continue to see more weakness with this ratio. Then we're looking at the relationship between cash and 3 to 7 year bonds. When this is going up, that means the market is concerned about interest rates going up, which they've been doing in the bond market, even though the Fed's been cutting rates. And they're worried about inflation. And these stronger than expected economic reports that have come out has been pushing this ratio back up. But when you look at this, tips. These are Treasury inflation protected securities. They adjust for inflation. That's what folks get into when inflation is a problem. And then you compare it to 3 to 7 year bonds where you lock in a yield for either 3 to 7 years. Then we're not seeing a real concern here with this ratio. So short term back here, we're seeing a problem. More intermediate term, 3 to 7 years, not a problem. It starts to become a problem again when we look at tips and then we go further out. This ratio is really starting to go back up as longer term interest rates are going back up now. And this is a bit of a concern. And if this keeps going up, that could put more pressure on the market. That just means they're worried about inflation and interest rates are probably going to keep going up. Then we want to keep an eye on international rates. And the one that I'm focusing on is Japan. You notice back here in August, when we got up above this 1% level, Japan hadn't seen that in a long, long time because they've been trying to stimulate the economy over there for decades. They even had negative interest rates for a while. Well, when we got up to 1%, basically you could borrow yen for zero interest and then take that money and go put it into a better performing asset. Well, when we start to get up above 1%, that throws that whole thing into whack. And that's what kind of was the catalyst for the problem that we saw last summer with the big down day. Well, Japanese rates are now going back up. Is this going to create another problem like we saw last summer? Don't know. Just want to be aware of it for right now. And then Zwag NYC breadth for us, we're kind of starting to get out of the window here. We came down and we crossed back above point 0.4. We have 10 trading days to get up to the red line. We're not even close to the red line here. But if this does end up triggering, that could be positive. In the meantime, we're just watching this. Staple sector. A week ago, I was pointing this out as a point of possible support. We came down to the 200-day moving average. I thought, well, maybe we'll get a little bit of a bounce out of that. Nope, we're breaking below it. Now, that could actually be positive for the market because staples are defensive. Toilet paper, toothpaste. People have to get that stuff no matter what's going on in the economy. And the fact that this is showing weakness could be positive for the market. Go back to 2021. Notice how staples were doing really well at the end of 2021 and they held up pretty good in 2022 while the market was going down. That's what people get into when they're getting ready for the market to really decline. Now, we were riding an up wave here in most of 2024, but the S&P was also riding that wave too. I kept pointing this out in the daily videos, but it never really developed into anything. This could end up being positive. And I'm using the chart for a different reason this week than I did last week. We broke below the 200-day moving average, but this coming down, we're not seeing strength in the staples that we were before the market got ready to really decline. So we'll keep watching this as well. Oil going back up now. It spent a long time right around the 70 level. Now it's starting to go back up to 76 and a half. We're seeing some commodities bouncing now, and that can be more inflationary as well. The dollar really strong. The market likes a weaker dollar for exchange purposes and in import-export relationships. We're just really screaming up. Now, if you're in the US and you want to go to England or Europe or Japan right now, you might want to consider doing that. You get a pretty favorable exchange rate. If you're in the stock market, you're concerned about this. If you're a tourist, you like this, doing better. All right, and then we have the Hindenburg Omen. And if you don't know what that is, here are the three criteria that go into that. And then here's the chart. We don't have another spike up, at least yet. Perma bears love this thing, and they treat a hint of a spike, not even a real spike, as, oh, it's here. It's a confirmed Hindenburg Omen. Well, we had the initial spike come up, and then we had another one come up, and that confirmed this, but we haven't seen any more since then. And we want to pay attention to this because right before the COVID crash, we saw a whole lot of spikes. At the end of 2021, we saw a whole lot of spikes. We're going to be watching this now to see if things are turning more negative. But so far, we have not had an additional confirmation here. Thank you. I really hope you found this helpful. Please check out the daily videos because that's where I update all these charts that I talked about in this video. And then we try to present scenarios as they're developing throughout the week. So have a great weekend and I will talk to you in the next video.